Let me continue by exploring a little bit what I think could possibly be done to, again, put the genie back in the bottle and potentially move us back to a global system of money that's based on the Bank of Amsterdam model. No doubt this would not be easy, and there are many details would have to be worked out. But what is essential in my view is that this would have to be done by international treaty, that major countries would have to come together and agree to create in their own country a publicly owned system of banks of deposit. And the banks of deposit would each be empowered or authorized to mint coinage of a standard weight and metallic content that would be universal. So the coins issued by the bank in the United States would be the same as in the United Kingdom, would be the same as in France, would be the same as in China, would be the same as in Russia, etc., etc., etc. And so now the existing challenge of constantly dealing with exchange rates between currencies and with the instability that creates on the part of people engaging in commerce, those who are investing, etc., would be largely eliminated. The whole market for speculating in currency exchange rates would essentially be removed from the global economy. Now, we do need to use gold and silver for other purposes. They have purposes in manufacturing. They have purposes that we have in art, and we use these precious metals for jewelry. So there's going to be some percentage of the gold and silver stocks of countries that exist today that can be minted and used as the backing for the new digital currency that would be given as deposit balances to those who become members of the deposit bank. So, you know, businesses all around the world could bring whatever gold they have in their possession that they no longer need for other purposes to the bank. It would be minted, and they would then have that balance on deposit. Now, the arguments against this system, again, are related to the supply of precious metals is limited, and the expansion of that supply by mining is environmentally harmful. So, agreed, this is part of a problem. But on the other hand, we have relied on gold in particular, but also silver as desirable objects of possession and as sources of value that have remained constant throughout history. Our desire to acquire these precious metals continues to this day, whether or not we have practical use for them or not. It has something to do with our aggregate demand for these precious metals as a storehouse of value, as a hedge against inflation, and as a last resort to our ability to acquire other goods we need in order to survive. However, it's certainly true that there may be other commodities that can back currency. And in local network systems, local currency systems that have been established around the world, there have been other commodities and even labor units that have been used to standardize the exchange value of currencies that are in local circulation. So all of that is possible as an expansion of the system. The key is, in my view, that the currency in circulation has a stated redemption value in something tangible, whether or not that tangibility is precious metals, labor hours, firewood, or as one economist has put forward as an idea, the one of the commodities that has a pretty uniform demand around the world and is easy to produce but is difficult to destroy is construction bricks. There's no need to store them in a giant vault to protect them from theft, and they are readily produced. And so, one of the sources of redemption could be in a value or quantity of construction bricks to secure digital currency. That could be added to the system that has precious metal. So there's no reason I can think of that the redemption of currency has to be strictly limited to precious metals. But we need to utilize commodities that have a pretty standard, consistent value in the global marketplace. And construction bricks seems to meet that. And there may be other commodities that also meet this requirement. So that's basically the argument I make for returning to the system of banking that was created in 1609 under the Bank of Amsterdam. The history of the bank indicates that it has to be closely monitored and regulated. We need to have external auditors to make sure that the system is kept honest. In the case of the Bank of Amsterdam, eventually the city of Amsterdam looked to the bank to provide funds for the city on a lending basis, and so the bank, which had earnings, people actually who made deposits with the bank paid a fee to the bank for those security services, for taking care of the monetary system. So the bank had its own assets, and it could lend those assets to the city of Amsterdam or any other entity legitimately because it was their money. On the other hand, things could easily get out of control, and there were problems that arose during the tulip bulb bubble, which put the bank in some jeopardy. And eventually the bank lost its ability to be a redemption bank because it did not have adequate reserves to redeem all of the currency that was in circulation, including some banknotes that were not backed by coinage in the bank. And from that point on, there's been no central bank established by any country that's had full reserves. The Bank of England, for example, in its charter, had some percentage of its currency to be backed by reserves, but it then, it guaranteed redemption of its currency based on the taxing authority of the British government and the promise of the British government to make depositors whole. So the system gradually expanded around the world of fractional reserves because it was observed correctly that not everyone's going to show up demanding their money, other than when there is a dramatic panic. And all of a sudden people really see that there's danger that they won't be able to obtain any of their assets that are on deposit with banks. And so we've had banking panics, and we've had to have the systems to back up the banks so that when there are runs on the banks, the central bank would be the lender of last resort and provide those funds. And that hasn't worked very well either. So now, what do we have in the United States and in other countries primarily? Redemption currency has disappeared. The notes issued by the Federal Reserve Bank are essentially what I would call promises to pay nothing in particular. The exchange value of a dollar, a Federal Reserve note denominated as a dollar, changes daily. So one day it would buy you, a candy bar. And the next day it might buy you half a candy bar. And a week later it might buy you 2 candy bars. all depending upon the confidence that the marketplace, that the global economy has put in the relative or comparative purchasing power of the US dollar against other currencies in circulation. So this is a very volatile, chaotic system that we have, and it tends to benefit over time those who are debtors over creditors. Because if you're holding your savings in a bank at a fixed rate of interest, with inflation and debasement of the currency, you're losing purchasing power on a regular basis. And so it benefits those who are borrowing and are paying back tomorrow in currency that has less purchasing power than when it was acquired. Well, that's a big part of what I think needs to be done. Now, I'd like to move on to another discussion that is going around on the part of reformers and economists who have questioned the validity of the current monetary system, and with banking in particular. And this has to do with whether or not commercial banks, individual commercial banks or savings banks or other financial institutions, have the ability to create money out of thin air by making a loan. And my background is in accounting, and for a number of years I was a manager of a residential mortgage lending program for a commercial bank, and one of my responsibilities was to document our accounting procedures. So with that experience, I have really come to question how it has been deduced that individual banks have the ability to, in fact, create money out of thin air by making loans. Accounting procedures, rational accounting procedures, the requirements under what in the United States are called FAS rules, financial accounting standards rules, really make this essentially impossible to occur with regard to the individual bank. Certainly the system, the Federal Reserve Bank in the United States and other central banks, those central banks have the authority to create monetary medium out of thin air, and they do so, and that's what we have. We have quantitative easing. But the individual bank has a number of ways to raise money. And it's worthwhile considering, for example, how is a bank created? Well, a bank is created by individuals deciding to start a bank, and they bring their assets, their cash to the table in exchange for shares of stock in the bank. And that cash becomes part of the bank's initial assets, and the shares of stock that are held by the individuals becomes their asset, and the bank has the cash as its equity. Now the bank will then go into business, it will announce it's in business, and it will attract deposits, and the deposits bring in cash. Cash adds to the cash on hand available for lending, creating an offsetting liability. The liability is the fact that they have taken a loan from depositors, essentially. And so they have additional cash to lend out, which they do. And when they lend that cash out, the amount of cash available to be lent out declines. And on the other side of the balance sheet is a loan receivable made at interest. And so the borrower receives those monies, and through their own activities, it raises sufficient revenue, hopefully, and their income perhaps, to repay the bank, and also pay the bank more than was loaned to them as a fee for the time value of money extended to the borrower, basically a transfer of credit. The bank can also issue debt. The bank can issue bonds, sell the bonds in the marketplace. Investors looking at the bank as a good risk will acquire those bonds. The bank gets additional cash. The bonds are a liability, and the bank has to make loans in order to generate the revenue to pay back the bondholders, and that's part of the way the bank does business. The bank can and does acquire other assets. The controller of the bank is certainly going to be looking at the balance between assets and liabilities and whether or not there's sufficient equity, should there be any kind of a difficulty in terms of defaults on loans. And so for every loan that's made by the bank, they have to have some reserves held back in order to cover the potential for loan losses. And this is just part of the calculation of doing business, and the loans that are made are priced for that risk. So depending upon the credit worthiness of the borrower, the interest rate paid by that borrower for that loan will be higher and lower. And the amount of reserves that will be required to be held under the regulatory environment will be higher and lower based on that assessment of risk. And there's all the historical data and market experience that shows how much reserves should be had. And there are just many different calculations that have to be made to determine that level of risk and how much capital a bank must in fact have in order to remain solvent, in order to cover its risks. If the bank runs into a short-term shortage of cash in order to meet an unexpected demand for cash by depositors, then the central bank is obligated, or its responsibility is to step in to be lender of last resort. And the Federal Reserve has to make a decision, do I have sufficient trust in the bank's assets to perform in long term in order to continue to make loans to this bank over the short term. And there are, again, all sorts of ratios that have to be met in order to meet those requirements. And there are external organizations that monitor the health of banks. So with the accounting requirements imposed on individual banks, I just haven't been convinced by everything that I've read that individual banks are in a position to create money each time a loan is made. If that were the case, then a bank would never become insolvent. The bank would simply be able to create net worth equity by making new loans and booking that as an increase in their net worth. So this is an issue that really needs to be further discussed at conferences and debated, and I'd like to see more evidence before I'm convinced that, in fact, everything that I've learned as an accountant and in banking has changed since I left the industry. Now, that could be, in fact, the case, but even in my subsequent 20 years working at Fannie Mae, we weren't able to create money by making loans. We had to go into the credit markets every day to acquire the funds in order to purchase mortgage loans, and then we were constantly buying. Our people were constantly buying and selling the loans that we had in portfolio in order to raise additional cash in order to keep the market fluid and transaction volume going. So I'm waiting and hoping. I'm going to continue to read and to listen to what some of the monetary reformers like Steve Keen have to say about this issue. But I'd like to hear more. I'd like to hear from some bank controllers or treasurers or bank auditors, not simply declarative statements by the governor of the Bank of England or some other central banking individuals. The language that's used to describe this seems to be, to me, very inconclusive. just general statements without any real proof. Well, anyway, this is the second part of 2 on money and banking. Just me trying to convey my thoughts on where we are and what needs to be done, and hopefully it'll be of some use to anyone who happens to run across this and take the time to listen. And I'll be glad to hear from anyone with comments. You can contact me by email at edod08034 @gmail.com. So thanks for listening.